Good afternoon and a very warm welcome to the JSE's last stock pick series of the year. For our new viewers, the JSE Stock Pick series kicked off in August 2021. And what it is, it's an online platform where basically we invite a host of industry's experts to talk about their various stock picks, go into details and tell us why they have decided to pick those stocks. And what a year it has been. As we race towards the end of the year, it has been a year full of volatility. My name is Helena Anti. I head up the equity trading at the JSE, and I'm happy to be your host today. And I'm super excited to be joined by 4 industry experts today on the panel. Anthony Clark, Independent Research Analyst from Small Talk Daily. Odwa Magwentshu, Portfolio Manager from Momentum Securities. Sithembile Bopela, Investment Analyst Research at FNB Private Wealth, and Nkanyezi Mwelase, Senior Analyst at Miyazu Asset Management. Welcome. So just to break the ice, Anthony, I'm going to start off with you. If you could just tell us, what stock did you wish you had never looked at, and what stock did you wish you have picked 1 year ago? In 2 quick lines.
Oh, that's a great one. The stock I wish I'd never looked at so far this year is Cashbuilt. It's been a complete and utter dog. When I chose it at the end of last year, the economic situation in this country was different. And as we all know, 2025 has turned out to be an economic basket case. The stock I wished I'd looked more at was Stadio. I own Stadio. It's been a fantastic performer. But in the last couple of years, private education has powered ahead in this country, and the stock has more than doubled.
Well done. Very exciting. So without wasting time, Anthony, shall we start off with you? And you can tell us about your top 3 stock picks.
Sure. Firstly, it's nice to be with such an esteemed panel. And thank you to the JSE for allowing us all to participate in this education webinar. My name is Anthony Clark. I specialize in small to mid-cap stocks on the JSE. I have done for over 30 years. So most of my stock picks today are all going to be in my universe. As a quick précis, much of the action in the JSE this year has been in the top 40 sector, mainly NASPERS and process. And of course, those lucky to be in the gold and platinum sector. You would have had returns of probably over 30% year to date. The small to mid-cap sector has held its own up between 10 and 15% year to date after a year last year, which saw gains of over 50%. So my 3 stocks, without any further ado, is Grindrod, Premier Group, and Sabvest Capital, or commonly called SabCap. These stocks should be fairly well known to the listeners, and I've chosen them for a very specific reason. Despite the fact that global stock markets and the domestic stock markets are at near or record highs, there is a lot of political instability, not just locally, but internationally. And of course, geopolitics plays a significant part. I don't think any of us on this panel know when we wake up tomorrow morning what Donald Trump is going to say or what policies he's going to enact and the impact that'll have on global stock markets, yet alone on geopolitics. So I've deliberately chosen 3 stocks which have resilience, have growth prospects, and regardless of the economic situation in this country, should have a good 12 to 18 months ahead. Grindrod, trading at 17 Rand and 5 cents when I did this note, is year to date up nearly 50%. It's a 12 billion Rand market company involved in ports, logistics, and basically moving goods around. But the real kicker to Grindrod has been the fact that the government, realizing that Transnet is an underlying basket case and needs help, it's opened up the private railway system to what's called public-private partnership. And Grindrod is the only listed JSE company which physically has expertise in locomotives and railway infrastructure. It owns locomotives and it strategically has port operations in Durban, Richards Bay, but its biggest operation is in the port of Maputo, where it has the port of Maputo in conjunction with Dubai Ports International and a separate terminal called Matola. So as more private industries want to move goods from the farm, from a mine, or from industry to port, they'll probably use private industry a great deal more. And Grindrod is very well placed to be part of that entire supply chain and logistic network. We've seen in results year to date that the amount of cargo going through the port of Maputo is at record levels. And we've also had a management change in the course of the last couple of weeks. the well-regarded CEO, Kulani Mbambo, is leaving to go and join Kumba as their chief financial officer. And Kwasi Mbaso, who is the, again, very well-regarded CEO of Bulk Terminals, an insider with deep knowledge in moving goods around, is becoming the new CEO. The market took that move extremely elegantly, and the share price ran very, very hard. So despite the fact from its low point in the middle of July, the stock is up 54%. I still see further upside in Grindrod going forward as the benefits of the public-private partnership start rolling out in private infrastructure. And of course, more people want to use an independent private operator to move their goods to bypass Transnet. My second stock is Premier Group, the country's largest miller and baker. It has brands, for example, such as Blue Ribbon Bread, Snowflake Flour, and Awiza Mealie Meal. It also owns Mr. Sweet and Manhattan in the confectionery line. It's trading currently at about 162 Rand a share, a 21 billion Rand market cap company, and year to date it's up about 22%. Now, the really interesting thing about Premier is it's had a fantastic series of growth vectors for the last 2 years, between 20 and 25% growth in earnings every 6 or 12 months. And that is not going to stop, at least for the next 24 to 36 months, because the efficiencies and the capex it's made in expanding its nationwide bakery network to make itself one of the lowest cost, most efficient bakers of bread in this country. Now, in the last couple of weeks, it's also made a 5.2 billion Rand acquisition for a sector rival called Rhodes Foods Group, which brings into the stable, if the transaction is successful, a very well-known brand of ready meals that goes into Woolworths. It also has a combination of Rhodes fruit juices, as an example, and a basket of other groceries, such as Bull brand meat brands that'll fit very well into the Premier operation. So Premier is currently light on groceries. Rhodes is strong. Rhodes has very good brands in jams, tinned fruits, pies, juices, and of course, ready meals. And both companies have an extremely deep relationship with Woolworths. So this combined platform brings an additional 8 billion Rand of revenue to Premier if it's successful, with significant cost savings ahead. So I'm forecasting that Premier over the next 12 to 18 months will have an uplift in its underlying earnings from a Rhodes transaction, not just from the addition of its profitable portfolio, but also from significant cost savings. At 162 Rand, I see significant upside going forward into 2026. And my last stock briefly is Sabcap, an investment holding company run by the experienced entrepreneur and well-regarded businessman Christopher Seabrook, who's got decades of experience of creating value for shareholders in this country. The current share price is 125 Rand, market cap 4.8 billion, and year to date the stock is up about 37%. Now, the discount to net asset value has fallen materially in the last few months. It is currently at about 9%. It has been as high as 25 to 30. That is because prospects for this company have ratcheted up in the last few months due to a number of strategic acquisitions and turnaround stories within Sabcap. Its top 4 assets are SA Bias, involved in trimmings and things in the garment industry for export, Apex Capital Partners, an investment holding company, ITL, a labeling business, and DNI 4PL, involved in payment solutions and telecoms. But it's 70% of our portfolio. The company itself is expecting a significant uplift in net asset value for the year end to December 2025 and into 2026, significantly ahead of recent growth vectors. So despite the fact the stock has had a good run to date, I can see significant growth in net asset value ahead, and as such, the share price should respond correspondingly. So Sabcap to me is a core holding in any small to mid cap growth fund. So wrapping up, it is basically Grindrod, Premier Group, and Sabcap for any long-term growth portfolio interested in small to mid caps. Thank you.
Thank you, Anthony. I really like your passion, and as an investor, like you got me convinced here that these are really, really quality stocks to look at. And I mean, if you look at the performances that you mentioned, like 30, 37%, 50% plus, it's quite amazing. But I mean, if we look at our market itself, MSCI South Africa has delivered more than 50%. We're one of the top performing index in the whole world. So it is quite an exciting time for South Africa. And maybe moving on to you, Odwa, happy to hear from you. What was the stock that you wish you never bought, and what stock that you wish you bought, before you move on to your free stock picks?
One that I definitely wish that I didn't buy this year is Sun International. I had hopes that the business was going to do quite well, but the share price just is not going accordingly. And then the one that I wish I did buy is the dreaded Capitec, which you never seem to find a top two, that company. And it always seems too expensive, but it always seems to grow as well.
That's good one way. Absolutely spot on. Right, Odwa, do you want to go into your free top picks, please?
Yes, of course. So for again, it's a very volatile market right now. So I went for education, I went for financial sector, and also the REIT sector to try and benefit from the current market conditions. Starting in the educational sector, I did go with Stadio as my pick. Stadio has been a great performer amongst the three educational stocks we have on the JSE. If we look at the latest results, I mean, it had very strong double-digit growth in revenue, and also if you go down to the bottom line, also pushing a bit of pushing quite strongly on that front. I love their business model, which is the distance business model, and with that, it means that the capital expenditure doesn't deplete too quickly, and they can, they have economies of scale in trying to address the current situation we have in South Africa. One thing that also works for them very well is the supply that we have in South Africa in terms of students, more than 500,000 students not finding a home in the state-owned universities. That's where they currently have a great opportunity to take up. And if we look at the results, the latest results they've also released, we have seen some great performance on that side. In terms of how the business is performing, and in educate students enrollment, they also had a growth in that. So overall, I am loving Stadio in terms of the educational sector. And then if we move across to the financial sector, I have picked Purple Group. Purple Group is well known for one of its subsidiaries, which is Easy Equities. The retailers, stockbroker of choice, have had a lot of nice growth in terms of the client base in recent years. However, it's the expansionary vision that I'm seeing in the business which attracts me. Firstly, not only have they moved further than the capital markets that they offer, not only locally but internationally, they have also gone into bonds and also retirement annuities. And now they seemingly finding the baseline. And what I'm also liking, especially if you look at the last results, is that with where the revenue is coming in, a lot of more than 50% is actually coming from annuity businesses, which is then giving, or inactive businesses, which is then giving them a nice base in terms of getting revenue, and also the balance sheet is always going to look consistent rather on the back of that. In terms of expansionary vision that the business is having as well, they are expanding into other countries rather. Looking at the Philippines is one of where they are still looking to get in there. They still need a few checks checks and balances to go through, but they are looking at expanding in the Philippines and in Kenya in terms of the broader African space. On that base, I do believe that the company is well positioned, especially with the investments they've made over the past few years in order to capture those different markets. And then we also then go to my third pick, which is Sirius. Now, Sirius is a real estate, a REIT rather, and Sirius Real Estate has done 470 million euros in terms of acquisitions this year, where they are buying a lot of plants, mainly light industrial properties, and they are mainly fixated in Germany and in the UK. Now, the reason why I'm liking it in these different spaces is, number one, they are currently the acquisitions are for companies or properties which are already operational, so there's no building from scratch, and they're already going to be bringing in some profits, which then hits the ground running on that front. So I'm really enjoying that side. And then on the dividend side with the REIT play, they are paying a 6% dividends right now, which is great income from the business, and also they are recycling their portfolio. So over the years, they have had some businesses where they aren't performing as well, and they've decided to sell them. One of them is the Hunderfield properties in Germany, where they've sold it at a 7% premium. So in an overall business point of view, they are managing to also sell non-performing properties at a profit, which I think is quite commendable, especially in this market. One other thing that has come up about right now is as we're going towards the year end, we are expecting the budget discussion to come from the UK, and there's going to be investments, especially to try and prop up the UK economy, and that's where I think they are well positioned with regards to these strategic purchases they've made in light industrial properties in that region. And in the European part side of things, if you look at the German business that they've gone for, Germany has also stated that they are looking to put more funds into propping up the companies, I mean the country's economy. So there is some positive on that front, and then also the defense spending. A lot of the properties they've bought are along the harbors, which would then benefit from increased imports and exports. So overall, they have made some very good strategic purchases, and the management is doing quite a very good job on that front.
Great, thank you, Odwa. Very, very insightful. I really like your passion, and I'm quite interested. Like your first choice is, quite an interesting one. It's in education, and it's got a social aspect to it. I mean, this morning we had the listing of Optasia to the JSE, and there was a proper vibe, proper excitement. Because they're a big fintech company, and they come with the whole about financial inclusion. So it's I guess as an investor, there's different angle to it. Yes, we're all driven by profitability, but if you can have profitability angle with a social aspect, that is quite empowering. Maybe I can take the EFC. There is a question now, and it's not really angled towards anybody. I think any of the panelists can answer that. So the question came from, I guess, Capitec. So the question is, on Old Mutual Bank, can it emulate what Capitec has done in terms of evolution? Anyone wants to take that one on? What are the votes of Old Mutual being a retail bank? And if we have to compare that to the success of Capitec, as you rightfully say, Odwa, sees no end, because whether it's onshore, whether it's offshore, people just love Capitec, and it has been a true success story. Anybody on that?
Let me take it. I think with regards to Old Mutual's business plan, it does. There is a successful business to at least emulate. I think, however, it's going to be quite difficult to try and copy the success. As now, the class that Capitec has captured is what Old Mutual will be looking for, and it's going to be quite difficult to try and take those clients away from it. I do hope that things do work out. If you look at other banks as well, for example, Bank Zero and the One Time Bank as well, they have also managed to get a few client bases. However, they've also struggled to grow at that pace in which Capitec has done so. Another thing in terms of how they're going to go about it, they do have brick and mortar operations across the country. However, how will they put that or synergize that in order to service these banking clients that they're looking to get is going to be the big question. I think there's still going to be a lot of front. But the good thing on their side is that they've got the clientele as a business, and hopefully they can leverage that to try and build the business much quicker. However, in terms of sustainability, that still remains a question.
Yeah, I think that's a very fair feedback. Anybody else wants to add on top of that? No? Okay, so maybe we can move on to you, Sithembile, if you're ready for us. Before we go into your top 3 picks, which stock has been your biggest nightmare this past year that you wish you've never touched, and which one did you wish you bought?
So not necessarily a nightmare, but perhaps as many other analysts, I was more bullish on the retail sector coming into the year because of improving sort of macros and sort of improving trends for consumers in general locally. But so early on in the year, one of my stock picks was TFG, which I think is a quality business with very good growth prospects. But I think in this environment, Pepcore was a better sort of contributor just in general. And so I did see, the TFG share price did come under quite a bit of pressure. I think they were down about 40% year to date, whereas Pepcore is up about 15%. So perhaps a switch of those two would have been in my favor.
Very fair. Yeah, unfortunately, we're still seeing, our retailers lagging behind. I think Anthony mentioned the biggest driver, what's driving our market has been mostly the commodities and your few stocks like the Naspers and the MTN, whereby performance is really driven by, the African or non-South African business. So it will be really good to see, at least this sector that and the local, just SA domestic in general, really tick along in the new year. So moving on to your top 3 picks, Sithembile, without wasting time.
Yeah, so today my stock picks are technology solutions provider DataTech, as well as fintech payment infrastructure group Araxi, and I also like the education space, but my pick for today was AdviTech. So starting with DataTech, they do have a leading information and communication technology or ICT distribution, but also services capabilities across 50 international markets. So very well globally diversified. And as much as, they're not a pure play AI company on the local markets, they are, I think, very well positioned as an important player within this global growth trend that we are seeing. In terms of the business itself, I am oversimplifying, but their business is essentially to help other businesses build and manage their IT systems with specific focus on the tech distribution, which is the cybersecurity tools, the networking gear, and the cloud solutions, which we've seen take up, across global markets rather, has had very strong demand. And then the other operating segment that they operate under is the IT services company Logicalis, which designs and manages the systems for clients across both private and public sectors. So again, some diversity in terms of the consumer base there for them. And why I think DataTech is particularly interesting right now in this environment is the rise of AI is driving, demand for faster networks, for secure systems and cloud infrastructure. And that's exactly the space where DataTech is well positioned. And one of the sort of key strategic shifts for them over the past few years has been the move from selling mostly hardware to offering also software and services, which have better margins and more recurring revenue. And so they're moving from a sort of quote unquote box mover to a solutions and services provider, and that's been a big driver of profitability for them. And so even on a valuation, a 6 times forward PE multiple, they are trading at a bit of a discount to their history, which I think is just undemanding for a company that's growing both margins and cash flow. And from their recent numbers, I liked the sort of improving quality of earnings that we did see, specifically the operating profit conversion into double-digit earnings growth was quite a key. Also, the strong cash generation for them, the global reach and the exposure to AI-driven demand, as I mentioned earlier. And I think as leadership continues to keeps shifting to annuity-driven services revenue, so that change in mix to sort of ride the AI wave, the market can start to price data tech less like a low-margin contributor or distributor rather, and more like a hybrid services and software renewals platform. Then my next stock pick is ADVTech. It is one of the largest private education groups on the continent, and it is a stock that does combine, steady growth, strong brands, and exposure to a sector with real long-term demand. They do run over 100 schools and 30 tertiary campuses across South Africa, but also in broader Africa as well. But they've also got a recruitment arm for professional placement, so really just capturing the value chain in that space. I like that in SA, but also in Kenya, in Botswana, and Ethiopia, which are markets that they've recently expanded into. They've effectively bolstered their exposure to markets with growing middle classes, but also strong demand for quality education. So I mean, this is a long-term story. Education is a structural growth sector, and with public universities, running at capacity and public enrollments having tripled since over the past 5 years, I think ADVTech is definitely riding that wave and printing double-digit growth in tertiary enrollments, but also the schools are benefiting, I think, in large part from, as I mentioned, that growing middle-income market. So I like the growth narrative. The fundamentals, even just from a demographics perspective, are quite supportive. Yes, exposure to the macro cycle in terms of weak economic growth, modest wage growth, etc., that does tend to pressure household budgets in the short term. So bringing in a bit of cyclicality to the story there. But I think operationally, the performance has been solid. The balance sheet is in a healthier position. Cash generation has been strong, and debt has remained quite low. So giving them room to sort of fund their expansion, which they're doing through both organic growth, but also acquisitions as well, without stressing the balance sheet too much. And so I think beyond the brick and mortar sort of growth plans, they're also using technology and AI to stay ahead, which, I think that tech edge does improve their outcomes and strengthen, the sort of brand and the story around the name. But add to that the rise in distance learning, which is cheaper to scale. It does fit perfectly within their sort of tech-driven approach, so giving them a bit of a competitive edge there as well. I like that their multi-brand strategy also serves, households across the LSM segments. So from premium to budget markets, the tech-enabled learning does give them an edge over smaller rivals, but also the Africa expansion, given the growth forecasts that we anticipate from those regions, does add just a second growth engine and diversification away from weak SA fundamentals. And so bringing in a bit of resilience through the economic cycle there. And from a valuation perspective, they are trading at around 13 times forward earnings, which is still below their historic levels. So for a company that's delivering consistent double-digit growth and strong capital returns, I think buying into a quality compounder here in a sector with long-term tailwinds. And then finally, Araxi, which was previously Capital Appreciation before they rebrand just last quarter. So Araxi is a local fintech player that's well positioned for changes in payments and enterprise tech. They offer payments infrastructure, so the hardware in terms of actual points of service or POS devices or card terminals, but they also, through their core innovative tech within HaloDot, they offer this cutting-edge tap-on-phone technology that turns smartphones into a payment device. So, but it's not just the phones, but also tablets and what they call commercial off-the-shelf devices. So as long as they are NFC enabled, which I geeked out over when I was looking at the company, because I think it's just pretty cool that you can turn anything with an RFID chip into a payment point. Very future is now, but anyways, I think the business is, they are in the business of enabling payments through physical infrastructure, so the POS device sales, which I mean, the market is anticipated to grow quite strongly for the rest of the decade, with CAGRs of around 9% year on year. So I think that exposure is quite significant for them. They've moved more recently. They've pivoted towards rentals, so not just sales, which I think has had a positive mix shift for them. The rentals allow for recurring revenue, so more annuity type income, which longer term does drive better margins. But also the software business is very important for them, especially as, cloud migration, but also demand for data and analytics, security solutions, and as AI projects in general accelerate across banking and enterprise. And they have key partnerships with, multi-vendors such as Amazon Web Services, which I think does just give them credibility in an otherwise very competitive enterprise tech space. So the big story is payments going software first. It's a big trend that we're seeing across the sector. But add to that the broad-based rise of contactless payments. We are seeing accelerating growth of cash to card to digital payments. So the POS market is undergoing a significant shift driven by, in one part, digital innovation, but also changing consumer patterns, and also businesses' sort of responses to macroeconomic developments as well. And so I think also the fintech adoption in sub-Saharan Africa is accelerating ahead of global averages, and that's been thanks to accelerated smartphone penetration. So the demand from the end user perspective is very much a strong underpin for them. And so as an enabler of real-time payment rails, of value-added services, I think Araxi is sitting right where the growth is and is going to come from. The price of the share rather is trading at around R1.61, but on a 7 times forward PE multiple, and a discount to the peers. So we do see some upside from current levels, just given the fundamentals. So this, I think, is quite an undemanding level, given the robust potential sort of growth that we expect to come from the stock.
Great, Sithembile. I think I can hear the passion, and I think you're mentioning all the buzzword there, like the cloud computing, AI, fintech, as we mentioned, like Optasia listed this morning, and not just the biggest fintech listing in Africa, but in the whole of EMEA, in the whole of EMEA. So it just shows the appetite that's out there and the potential. And interesting how you also choose something in education and, something that has this whole regional diversification of the rest of Africa. So very good stock picks. I'm sure the users will find that very, very insightful. We actually have a question from the audience for you, Odwa and Sithembile. Maybe you can also add regarding the higher education institution. How do you analyze the legislation change that recognizes those private institutions to be recognized as universities, and how does that affect the stadio? That is a tricky one.
It is very tricky. To be honest, it's not one I've given much thought to. I would have to come back. I don't have an answer at this point.
That is fair. And Sithembile, given that you also chose education there, any view on that?
Yeah, I think it is a bit of a tricky one that I also haven't sort of chewed on. Perhaps some homework. Thank you for the question. But yeah, I think it's, the demographics, given the accelerating sort of birth rates and also student rates across South Africa. And as I mentioned, universities are, at capacity right now. And so I think broadening of the education landscape really just serves to benefit not just the companies that we've spoken about, but I think the broader education markets in general, which is, short answer.
Yeah, no, that makes sense. I guess the whole point is, if you're attending those institutions, is whether they're going to be recognized as universities, and whether you're going to be able to easily find jobs, right? That is the whole point, and the whole question mark on it. Right, and there's another question, maybe, and it's not really addressed to anybody. Any view on Chelsea's listing end of November? Anybody has any view on that?
Maybe I can try and take that one
Sure.
because I've picked a company that's in that sector. But my view on it, I mean, I think I see it as just a listing, but I don't see it having a major impact on the competitive landscape because already Cell C is a company that's an incumbent already. So whether it moves from being unlisted to listed, I'm not sure if it will change the business model or even change the competitive dynamics within the South African telecommunication sector. So I see it more as a listing, but not necessarily as something that will change the playing field within the sector. So it's a great thing that it's listing. It gives us more opportunities to invest in, but in terms of the competitive dynamics, I'm not sure if it will change anything from that side.
Yeah, and I think that's a very good answer. So we just staying with you in Nkanyezi. So which stock is really hurting you and you wish you never touched, and which stock you feel that you've missed out on?
I think the stock that I feel like maybe I've missed out on was not doubling down on Sasol. So Sasol, I took a little bit pain on Sasol and I stayed out of it, but I think I should have doubled down on Sasol given what it's doing right now. And it's the stock that I really feel like, the guys on the team want to skin me alive. So I also operate with the absolute return side of our platform. I motivated for Aspen. I built a very strong case for Aspen. I said, guys, let's put a structure around Aspen, even if it's an ELN or a derivative structure around it. And we did. And 2 weeks after I said that, they announced the loss of a contract, and like the guys want to break me in half. But that's the that's the stock that I really feel like I took a lot of pain on. Yeah, and those are just the two stocks where I feel like I maybe it's been giving me a lot of stress. Yeah.
And that's the beauty of investment. It's, there'll be good decisions, there'll be bad decisions. I mean, even though we think we know it all, but that's the beauty of the market. We don't. There's new information that keeps coming, and you just have to be super, super disciplined and know when to cut your losses and move on.
Definitely.
So thank you for that, Nkanyezi. Right. So without wasting time, what is your free stock picks for today?
Okay, so my initial stock pick, so my first stock pick is Lewis. So I've picked Lewis, though its share price has actually rallied, but I picked companies that I think have some sort of element of quality within those business. That's the criteria I kind of used. And most people will be familiar with Lewis, with the Lewis Group particularly. It's a furniture retailer, home and appliances retailer in South Africa, but it has operations within the SADC region, like in countries like Eswatini, Lesotho, Namibia, as well as Botswana. So the country-specific risks are not much different from those of South Africa. But also the company operates around 500 stores, but most of the stores, about 900 stores, most of them, around 500, come through via the Lewis Stores Group, which people are familiar with. But they also have Best Home and Electric, Bears, UFO, and the newly launched Bed Zone, as well as the newly acquired Real Beds, where they want to expand within their specialty business to try and capture the market share within the bedding space. And obviously, as I said, the company is predominantly a South African business when you look at it, because a large portion of its revenue is generated in South Africa, with a small portion coming out from the surrounding countries that we operate in, and it's largely a credit-driven company. What I like about the company is more, the relatively diversified nature of the revenue new base, in a sense that it doesn't just rely on merchandise sales, but it also has different revenue streams in the form of insurance revenue via their Monarch subsidiary, which is the insurer. So you buy an item, you get insurance on that particular item, it benefits the group. They also provide financing. If you buy on credit or on hire purchase, they provide financing on a fixed term for about 3 years. What that does is that even after selling the particular item, they're able to at least generate some sort of interest income, annuity income for at least 3 years on a fixed term basis. So in an environment where interest rates are coming down, they are continuing to collect interest at the previously agreed upon rate, which is much higher over a 3-year period. So it continues to get generated annuity type of income. But they also have ancillary services, which is relatively significant, which is more like delivery fees and so on for the equipment. But what I like about Lewis as well is that it's a constant dividend payer. So it has one of the highest dividend yield in the JSE. So for an income investor, somebody who wants to gain dividend, Lewis is a great dividend payer. They've been buying back some of their shares. but they've stopped the program right now, given what the share price has done. But over the years, they've continued to buy back shares, which is give return to shareholders, but also on the returns that you generally get from Lewis, relatively stable and high returns on equity on your investment. So I like that business for those kind of reasons. And also, when you look at gross margins, most retailers, when you look at their margins, they tend to be a bit volatile. But if you look at the gross margins for Lewis, they've been able to consistently increase the price, not lose volumes, and also maintain that margin. So that tells you that it's a business that can increase prices but above the cost of that merchandise and continue to maintain that profitability. So I like that about the business. So you don't see much volatility in the earnings of the particular business. They are able to increase prices without losing volumes. But also on the cash side of the business, which is linked largely to where I think the market is currently valuing the business based on the debtors book, but the debtors book is one of the strongest and quality debtors book. So when you look at the collection rates in the business, they're close to around 80%. And if you look at satisfied paying customers, they're also above 80%, while at the same time they are also able to reduce the defaulting customers as well. And this is likely because they introduce certain initiatives, which include debit order purchases, but also the ability for the client to go and pay at the store. It allows for Lewis to create that family or a close relationship with the customer. But the introduction of the debit order system has actually ensured that the defaults tend to decrease. And as a result, that even their credit scoring systems that they've introduced post-COVID have also ensured that, the kind of client that they pull in and offer credit to is a quality client that can service the debt. Introduction of the debit order means that you can collect on the debt, so it's quite strong. The debtors book is quite strong. It's quite lucrative for the business. As a result, the business is quite strongly cash generative for the business. But I also like the balance sheet as well. For years, Lewis has operated without having to go to capital markets with a very clean balance sheet with no debt on it. They've recently added some debt, but when you look at the nature of the debt, it's more or less something that they use for bridging finance. It's normally short-term debt that can be paid in a year for bridging finance. So the balance sheet is not as geared. So though the price has rallied, but I think that the quality of the debtors book will continue to support the business going forward. And I also like the prospects of the business. So they also have a subsidiary within their specialty business, which is called UFO. It was struggling, but it recently turned into a profit after being right-sized, as well as closing some stores which are not profitable. And I think continued rollout of Bet Zone, as well as Real Bets, the new acquisitions, that will stand well for the company's prospects going forward. So it's one of the companies that I've selected that I'm happy with Lewis, and they also offer some credit at Bet Zone. So I think that will continue to add to that interest income or that other income line item and the profitability of the business. And on the second company that I picked, again, it's a retailer. Most people are familiar with it as Woolworths. So affectionately known as Woolies. So yes, the retailers have underperformed. Woolies had some problems in the recent financial year, but this is a South African business, but it has operations in Australia, outside of South Africa and rest of Africa. But the rest of Africa segment is relatively small, also around surrounding countries, the Eswatini, Lesotho, and so on, but it's relatively small. Again, just like Lewis, it's mainly a South African business with a large share of the revenue and profitability coming from South Africa. The business is structured as in two segments. So, there's the fashion, beauty, and home, which you normally interact with as soon as you walk into the store, where you will see the clothing side of the business. Then there's the apparel retailer, the beauty and home, it's the, things like makeup and so on. And then the homeware you will also find within the store. That is about 20% of revenue and about 30% of operating profit. That side of the business had some problems in the most recent financial year. They also, with receiving stock, so they underperformed. They had to revise some of the guidance in terms of the expected margin, but it is the nature of retailer where there is a little bit of cyclicality. But we think that the repositioning of that business to focus more on areas where they have strength, particularly in the cosmetic side of things as well, that will stand well for the business going forward. The issues with inventory coming through in the port which then led to delays in availability of stock. That's something that's in the base already, and we think that they'll be able to offload that inventory going forward, given the nature of the inventory, which is more or less staple type of things. You know, they call them essentials, the chinos, the t-shirts, and so on, plain t-shirts. These are things that you can sell. They are not fashion conscious, they are not fast fashion, but that can easily go out of fashion. So we think they can offload that inventory going forward. And then obviously Country Road, the Country Road is an Australian retailer. The macro in Australia is actually quite poor, so that business is actually, I don't really push much value on it, given the challenges that it faces in Australia. And then the quality in that business, which I said I picked business because of the quality. My view, quality in that business is the food business. That business is just shooting the lights out. And you know, it's a company that's also able to pass on inflation, gross revenue without losing any volumes, contribute positively to profitability. And I think that because of the quality of the business, I would simply buy Woolworths simply based on the food business side of only for the food business. And then they've got the financial services business, which is more of an enabler for the credit cards, for the store card and the credit card, which is the joint venture between Absa and themselves. They only recognize a share of the profit from their particular business. But why I like Woolworths so much is more or less the food business. I think that the company has captured a certain high LSM market. And if you look at the nature of the client at Woolworths, it's somebody who has a high income levels. You know, they are high earners, the balance sheet is strong, the income is strong, but more importantly, they tend to focus more on quality and freshness of the product, and they're willing to pay for it. And as a result, Woolies is able to extract a large premium for that. And unlike, for instance, the customer that would shop at ShopRite, you know, that customer, you find that maybe 42 to 50% of their income tends to go towards groceries. So they're very sensitive to price increases, whereas a Woolies customer, it's a small portion of their income. As a result, it allows Woolies to continue to extract profitability from that business. So I think it's a business that has actually captured a niche. And I think it's quite difficult for other competitors, such as Checkers, for instance, to invade that particular space, though they've tried. But when it comes to freshness, Checkers continues to lag. So, and I think Woolies is able to defend that market share. And I think there's quality in that business. And that is why I really love Woolies, despite the challenges. I think, as I said, that fashion, beauty, and home underperformed, but I think that it will recover in the 2026 financial year. And on the financial side of things, the business, despite the challenges and guidance maybe to lower margins, but we think long-term there is value in Woolies, and the balance sheet continues to be strong. The company continues to be cash generative. And I think because of the quality element in the business that I see within the Woolies is something that I would be willing to bet on. And the final stock pick on my side, I'm not sure if I've run out of time, but the final stock pick is MTN. MTN is basically, we all are familiar with MTN as a Pan-African mobile network operator with operations in South Africa, Nigeria, and Ghana, and other African nations. But why I picked MTN is that I see quality in MTN, despite the fact that in South Africa, the market is relatively matured. The growth rates in revenue are quite muted. But as another speaker has spoken about, that there's a lot of fintech growth opportunities outside of South Africa. And MTN is positioned itself, particularly with mobile money, to be able to capture that growth. Secondly, if you look at South Africa relative to other markets, you know, when you look at the penetration rate of smartphones in South Africa, the penetration rate is estimated to be about 1.95 times. That means an average South African has 2 phones, whereas in other markets, you know, the penetration rate is below 1. So which means there's growth for opportunities for what you call a smartphone penetration that will drive data demand, that will drive what you call so it will drive data demand, it will drive demand for mobile money. The banking sectors in those countries as well are not as strong, which means mobile money transfers are continue to be a good opportunity for MTN. And if you look at countries like Ghana, for instance, where MTN is the leader. So another thing I love about it is that wherever MTN is, it is either the number 1 or the number 2 position. So it's first mover advantage. They've used it very well in the sense that they've been able to get into a country and build a moat around the business via the superior spectrum, the superior network, such that competitors are unable to replicate the network. You need to spend billions to be able to compete with MTN. As a result, they're able to continuously capture market share within those business. And if you look at Nigeria as evidence of that, you know, they were able to push through 50% price increases in tariffs in Nigeria without losing volumes, and they continue to gain market share in that market despite having passed on that particular tariff increases. So as such, I think that is a quality business. And with Nigeria having 10 positive in terms of the negative equity, there's potential for upstreaming of cash back to South Africa, back to the group particularly, and continued deleveraging of the balance sheet. But the balance sheet continues to be strong. The earnings continue to be strong. Though the price has rallied, I do think that there's potential legs on the company to continue to rally a bit further from where it is. But the growth opportunities are much stronger if you look at MTN and relative to peers, and the growth opportunities are in mobile money and data. So yeah, my final take, sorry for running over time, but
we
MTN
can
is
hear
my
your
final
passion,
take.
and I feel particular that you can go on, and you know, and we all know that MTN is one of the star performers, up more than 80% year to date on the exchange. So sorry to interrupt you. We are unfortunately running out of time, but yeah, we can all hear your passion about the retailers. I would have challenged you a little bit on the Woolies food piece, but there is one question that I want to wanted to question. For you, Sithembile, somebody from the audience asked, what is the growth potential for AXX and by how much possibly? I don't know if it's a 4 minutes question, but if you could answer that, that would be much appreciated. Can you please unmute yourself?
In 2025, still on mute. So I think the stock has come under a bit of pressure since their interim business update a couple months ago. But I think, you know, it did show good momentum carrying through from the prior period, which, you know, I think it was coming on the back of a more cautious software tone and sort of longer roadmap on the recovery there. There's been slower project conversions there. So I think some of the pressure also stemming from some of the one-off costs that were associated with remediation that they carried out in the second half of last year, which likely resets near-term sort of margin and earnings expectations. But I think the full interim will give more color in terms of the drag. And but yeah, I think there's definitely some upside to their numbers when we start to see the sort of micro POS pipeline wins begin to show up in the revenue line. I think we can expect some short-term volatility, but I like the investment case. We do have double-digit top-line growth forecasts for the next 2 years, underpinned by, on one part, the underlying demand for the group's sort of payment solutions have been very strong, but also they've got strong bank relationships, which are long-term and sticky in nature. And because of that banking exposure, they're benefiting from a positive tailwind for terminal estate growth. For there's a reinvestment cycle that's, you know, it's a sort of government mandated reinvestment cycle across banks to upgrade their POS or points of sales estate terminals to 4G and 5G compatible terminals by the end of 2027. So I think that's going to be a positive sort of tailwind for them, but also add to that, they've been able to maintain an ungeared, cash-rich balance sheet with consistent dividend payouts through the years. And so we do have about 20% upside on our numbers. And as much as there has been a pullback, I think, you know, it's a name to buy in weakness for the longer-term investor who can sort of stomach the volatility in the near term.
Thank you, Sithembile. There's quite a few questions as well. I'm just going to maybe try and do another one. Maybe in Nkanyezi, the view on cellular networks and the projected growth, with consideration to growth of fiber networks.
So please repeat the question.
What is your view on cellular networks and the projected growth with consideration to growth of fiber networks?
Selling the networks.
Fiber networks. Growth of fiber networks. Like, what's the potential of growth? You know, you mentioned that Vodacom is up 32% and Sasol is up 21%. So I guess the audience is asking, is it time to invest in the cell phone companies?
Sure. So, you know, with cell phone companies, they have rallied, you know, so, but I do think that there is opportunity for the likes of MTN to continue to rally. So the opportunity for growth is there. And I'm not sure what he meant exactly by the rollout of fiber networks, but I think if you consider the fiber landscape in South Africa, that's the one area where one would argue that MTN is possibly on the back foot in relation to Telkom and Vodacom on the fiber network, because obviously they don't have much fiber, and they would have to come for Telkom, and they're going to pay a lot for that. But yeah,
Right.
yeah, sure.
Okay, so look, unfortunately, we're running out of time, and it's been a super engaging session. We can all hear the passion from our esteemed panelists, and the amount of research and due diligence they've done about their stocks and how they feel passionate about it. So from my side, thank you so much for engaging with us. It's been such a pleasure to be your host today. And to our viewers, I can see that there is a lot of interest, lots of questions coming through. So please keep posting it and reach out to the four panelists here, and I'm sure they'll be happy to give more insights into those stocks that they chose to pick. So thank you so much for your time, and we look forward to seeing you again in the new year. Thank you.
Thank you.
Thank you very much.